Hello, everybody. So today, StoneCo reported their earnings for Q1, and they actually missed on the top line just by a little bit, by 0.3 billion. So really not that much in reais, especially not teeny tiny miss. And of course, the market being so short term, what do we get? We get down 7% after hours. Note that it's essentially flat. I mean, it's been flat to down since the beginning of the year, but for 6 months, this stock has been trading between 15 and 17 roughly for 6 months. In fact, if I go back to April 25, right, so about 25 days ago, the stock was at about 15.50. So it just dropped. It's back up. Doesn't really move that much. Don't pay too much attention to that, in my view. Let's talk about the business really briefly. So, what is StoneCo? As you know, StoneCo, one of the oldest stock that I cover on the channel. StoneCo is a 5% position for me. It's one of my preferred stocks out there. What do they do? What are they? Well, StoneCo is a mix of the Square payment terminal and also a mix of a QuickBooks. So QuickBooks and Square kind of to go together, but mostly a Square, right? Mostly payment terminals. If you see what they do is they set up these payment terminals in 4 broad type of micro, small, and medium-sized businesses, and they focus on food, they focus on retail, they focus on gas station. I'll get to that in a second. Their goal is to serve Brazilian entrepreneurs and to transform their dreams into results, knowing that they have well over 3 million customers in Brazil. And in Brazil, the world of small business is actually very common and much bigger than, say, what you would find in many other nations, especially micro businesses. For example, in Brazil, micro business is a type of business that we don't see in the US. A micro business is just one person, self-employed, who sells some food, some street food, or some, I don't know, hats on the beach, that kind of thing. And what's important is they've reiterated the guidance. So I put it right there, noting that the payment volume went down by 5% quarter over quarter, but that's well documented. That is because of Q1. It always drops in Q1 for payment companies compared to Q4, because Q4 was the holidays. So people spend during the holidays and they don't spend as much during Q1. So this is not an alarming pattern. We see this in all payment companies. But they've reaffirmed their guidance for 2024 and beyond, and that's until 2027. And you can see the growth number are very high, 13% transaction volume. Growth numbers predicted client deposit 26% a year. The credit portfolio, close to 100% growth they're predicting in their credit. So again, they gotta get credit right. The market may not like to see credit if they get it wrong. If there's a lot of defaults, etc. And of course, everything's predicted to grow much higher, including net income. The only thing that's predicted to grow very mildly, and that's a good thing, is administrative expenses predicted to only grow at 8%. So this is a business that is all about the growth still, all about the growth. Again, their past year, though, they also grew, right? So from Q1 23 to Q1 24, they grew transaction volume by 24%. They grew client deposits by 53%. They grew the client base, how many customers they have, by 33%. So they have 3.7 million small businesses working from them. They grew the take rate to 2.54%, which is stunning, because if you've been following this stock, a lot of people were worried about PIX, saying, because of PIX in Brazil, it's the end of the world. And I remember the CEO arguing with the analysts, telling analysts, no, you don't understand. PIX is not going to change much about the business, because Brazilians love to use credit cards. Brazilians love their rewards. If you follow Nubank, that's the case. Nubank started mostly via a credit card, and so Brazilians love their credit cards, they love rewards, and so they want to pay with those payment terminals. And that the CEO was right on that one, because the take rate went up by 15 basis points at 2.54. The credit portfolio, that's the main strategic focus on the business, restarting the credit. That's part of their grand vision. And of course, they're making money now, which is something that the market requested of them. Myself, I would rather see them invest in the growth and make less money. They don't need to make $110 million right now. Nonetheless, that is what they've made this quarter. So this is a stock that has a PE now, and that has, a price to EBITDA. It's a price to cash flow. This is a stock that is now making money, i.e. they have to pay taxes, but of course it's a trade-off, right? The more money you want to make today, the less you can invest in your growth for the future. Nonetheless, does not change much to the story. It's the time we live in today. A lot of investors won't consider buying a stock if you don't have both. That's what happens in the high interest rate environment. So if I look at the growth, the adoption is massive for StoneCo. It is massive. My style of investing, as you know if you follow the channel, is I try to buy a company at the early signs that their product is getting adopted by the market. So in the case of StoneCo payment terminals for small businesses in Brazil, that's the product. I try to get early signs of adoption, and then I ride that adoption wave. Until the market is saturated. And when the market is saturated, when the business has a stable, steady customer base, is not growing as fast, that's typically when I exit the stock. To me, StoneCo is a 10-year-old, and this business is growing. Remember, look at that chart. 3.7 million customers. I remember covering this stock 1 year ago when they had just crossed 3 million. So they went from 3 million to 3.7 million customers in 1 quarter. Sure, the payment transactions are not going as fast, but that has to do much with the economy and their take rate on the economy. The business is doing well on so many different aspects. So financial services revenue, again, if you compare to Q1 to Q3, so the slow quarter of Q1 in 23 compared to the slow quarter of Q1 in 24, you're still at up 16%. EBITDA, right, they're focusing on profits. So EBITDA is up 73%. But you can see financial services revenue, if you look at the full year here from 21 to 23, you had a 60% growth rate. The client base is still growing, so this is a general look ever since 2021 right here, but you can also look at the client base from Q1 23 to Q1 24. They grew by 33%, so that's also very good. And then the software business, not doing the best. I mean, at 3%, that's not very stellar, but it's profitable. It's a profitable business at almost 18% EBITDA margin, so that's excellent, and it's growing 65%. Of course, we're focusing on profits, knowing that they have some cross-selling opportunities when it comes to their software and who they're focusing on with their software. One last point that I want to discuss with StoneCo is their cash. So you can see their cash still increased by 87 million reais. So if I'm good in my translation, that must be another 20 million increase in the cash pile in the down quarter. So in a down quarter where everything is down 5%, they're still growing the cash pile. That is, I don't ask. I don't know why they're growing that cash pile. They hope to use some of that money for their credit business and their lending business, but they still have quite a bit of a runway and quite a bit of cash just sitting there, right? 5.11 billion reais, that's more than $1 billion. And knowing that, I was excited a few quarters back when they approved on Investor Day their 1 billion reais buyback. Well, the CEO on the call said they haven't started that. So they haven't started the buyback. They are saving the cash for a rainy day. It seems to me like it's a company that has a trauma related to its collateral issue that they had in 21, and that trauma is still leading them to be so conservative. They're very conservative, which is kind of why I put in the thumbnail. Boring growth. Well, boring growth is good enough for me. I'll hold it, but I'd I'd rather see them invest more in their growth. This is a common complaint if you follow the channel that I have on many stocks that I say I don't understand. Like this is the moment to invest in your growth, right? And no, they're catering to Wall Street. So that's just what it is. It's a safe stock. Are they gonna get rewarded with a higher stock price in the near term? I don't know. I don't really care about near-term price movement. I care about the long term. And so if I care about the long term, what matters the most to me is the valuation. And that is a cheap stock. StoneCo is still a cheap stock. So I've shown 3 other companies in the payment space to compare it to StoneCo, and I have StoneCo with 2 different assumptions for growth. One at 16%, which is what the analysts say, and one at 33%. So I got to 33% because I'm reusing the number of client growth. I'm using the client base as maybe a proxy or maybe a way to guess what the revenue growth is going to be, but I just don't know what it's going to be. But I think it's going to be well over 16%. The analysts are being unfair here. To me, it's going to be well over 16%. Is it going to be 22% or 33%? Big delta here. Not much visibility. I don't know. It doesn't really matter though to make the valuation compelling. So if you look at StoneCo, it's a business. If you do the run rate for Q1, you multiply that by 4. That's 2.4 billion instant. So what do you get? You get an enterprise value over sales for a company like StoneCo of under 2. So again, dirt cheap, and it's a company that has 74% gross margin, so makes a lot of money, still grows quite fast, and I'm obviously thinking it will be closer to 30% than 16%, and if you look at the valuation, it is the cheapest either way. So if you look at the analyst number, it's a 0.16, so again, that's top 20% cheapest in all of my coverage universe. If you look at StoneCo with 34%, which is what I use, you get a 0.08, so that's top 10% cheapest. That's as cheap as HIMS here. And EBITDA margin, I used 18%. Not really fair, because really Q1 is a down quarter, and we know the EBITDA margin is much higher in other quarters. So take this is like as conservative as I get, giving them an 18% on EBITDA margin. That's a little unfair. It should be much higher than that. But even then, with my estimate, I get a rule of 40 of 51. So well over the threshold, and you get a 34 if you use 18% EBITDA margin, 16% revenue growth, but I find that heavily sandbagged in my view. And when I compare it to a stock that I've been buying, so I don't buy StoneCo anymore because I have a full position right now, so I don't buy it anymore. But a stock that I've been adding to is Shift4. Well, Shift4 I find very cheap, but when I compare Shift4 to StoneCo, I mean, Shift4 is still a good third, 30 to 40%, 40% more likely here, 40% more expensive than a StoneCo. So Shift4 is still 40% more expensive in the way I look at it. So again, that's a testament to how cheap StoneCo is. That's not saying that 4 is expensive. No. Shift4 is very cheap, but StoneCo is even cheaper, and maybe that has to do, for a lot of these companies that have these valuations lower than, say, a PayPal, maybe that has to do with lack of visibility. A Shift4, StoneCo, even a Dlocal, it's expensive on an enterprise value over sales basis. But even Dlocal at 0.27 is cheap. These payments companies are cheap. They have good metrics. It's a sector that I like to be invested in. And then we have PayPal. I put PayPal in there, but I've exited PayPal because the growth for PayPal is just too low. They're as big as they're going to get, which means that it's just an EBITDA margin play at this point. PayPal is just a price to earnings ratio play. It's a play on the cash flow that we're generating for PayPal, and you can get a similar cash flow with, say, a StoneCo or a Dlocal or a 4 from a margin standpoint, but you also get the growth, right? You don't have to settle for low growth to get decent cash flow generation. You can get that same cash flow generation while not compromising on revenue growth. PayPal, that was the end of the story. Revenue growth is not. I mean, it's there at 8%, But since this channel is called Beat the Denominator, and I want to see 15% at the very least to catch up with monetary inflation, PayPal is drowning in the currency flood that we're currently in. PayPal is drowning in how many new USDs are getting issued every single year, and so you get a little bit of dilution. In my view, that's just my humble opinion on all of these. That's all it is. No investment advice, not financial advice, just entertainment. Hoping you were entertained. Please like, please subscribe. Thank you for watching, and have a wonderful day.